Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, big changes are coming, big rotations are coming. We're going to talk about it. Let's dive in.
Trade Genius.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening.
All right, Bob, where are we rotating to?
It's really interesting. So, I think everybody's been talking about the December to January flows effect ad nauseum. So I really don't want to talk about that. I'm really now looking at what's February to April going to look like. And I want to start up with a chart here saying, remember how people are like, oh, people are all worried about the market. Well, here's the CTAs. These are the people that you fade at extremes. And, the October low was that last dip down that you saw.
Right.
And if you notice, they are more bullish and more extremely positioned bullish than they ever have been in the history of keeping this chart. And I think a lot of it has to do with everybody listening to these quant guys talk about the flows in January. So everybody's pushing hard into this. Really what it's saying is that there's really no more, cash that's going to enter into this market that's not already positioned. Okay. Now, an interesting phenomenon that's been happening, Phil, is that there's been this, we talked about this, 2 or 3 days ago, where you have basically the oil market and the bond market are kind of like a seesaw on each other. Well, this next chart I'm going to show you is the seasonality for oil. Okay. And we now have a position for a 6-week move higher in oil per the seasonalities. And typically, oil and the bond yields go together. So we TLT hit a resistance area, and we have a lot of bond issuance coming up over the next 6 weeks. And so our view, at least my view, and I'm sure you'll agree with me, is that, these yields are going to creep up. It's going to put money into the oil markets. At the same time, it's going to build up stress, and it's going to be competing with this CTA positioning and the flows. And, it's funny because yesterday we talked about the market, Phil. If you were a call buyer Monday a week ago, you lost money this week, okay, going long in the market. Even with all these flows, the market didn't really do anything, and you got theta burned out to nothing.
Right.
And so, I think there's going to be this push. I'm not going to fight it. I'm going to ride it. I'm not going to be myopic on this. I'm going to be ready to step out the door here. My energy names are probably going to come back, and then I'll probably lighten up because February through March is kind of weak for oil. So I think we're going to get that rotation, Phil, and I think eventually it's going to put pressure on the markets. And as those flows subside, I think we're going to see a pretty hard move down in the markets once people are trying to position out to February. Remember, it doesn't have to go all the way to the day of the OPEX, right? People can start positioning for February, and if they're not rolling in the higher amounts of money into the February contract, Phil, then the market's going to subside because it's just really it requires ever increasing dollar amounts for this Ponzi on the derivative side to keep lifting stock prices higher.
Right.
I'll take a break on that before we get into the next charts. I want to see if you kind of feel the same way or if you have some different thoughts.
Yeah, no, and if crude oil goes back up, then we have inflationary pressures again. So, as far as what's going on in terms of the Treasury versus the Fed, I think it's painting a pretty dire picture in terms of trying to manage it, especially from the Fed's viewpoint, because the issuance is really not slowing down. Now, we'll see what the next QRA is at the end of January, but if they continue at the pace that they're on, at some point, the Fed's going to be forced to print because nobody's going to be able to handle the amount of debt coming out because we've just not seen this amount of debt at this rate of issuance ever. And so that puts the Fed in a bad spot. And if you couple that with going into a recession, which we're going to get into some data that points to that as well, what are you going to do? You have a recession, you're forced to buy bonds, you're going to create that inflation. What did you say? Inflationary depression, right? You've been saying that for months and months and months and months. And lo and behold, here we are, perfect setup for that. So we're on uncharted territory right now, and we're probably going to have an extremely volatile 2024. And how it ends is anybody's guess. guess, but I certainly think that we're going to see lower prices in the S&P 500 over the next few months.
Yeah, and the VIX is in the toilet too, so everything's positioned to the extreme. Now, these next two charts we're going to show you is the reason why probably the Fed's going to have to engage, and it might be too little, too late. This chart blows me away, Phil. This is the amount of companies, percentage of public companies that cannot generate enough operating profit to run their businesses. I mean, it's just absolutely incredible. They can't outrun their interest expense. It's basically, it's a drowning man and you're throwing him an anvil. And the only way out of this is that A, you cut wherever you can without being able to lose your revenue stream. 2, you swap debt for equity, which means you dilute your shares, which make them go, fall further. 3, you default on your debt. Or 4, the Fed has to come in and provide relief. But you're talking 25%. This is unheard of. Companies shouldn't be public if they can't maintain positive cash yields. And a lot of this stuff, you notice how it's been angling up since 2010, 2011. We let a bunch of garbage companies go public, SPACs, the whole 9 yards. And these guys, all they were is liquidity events for the founders, and they just stuck the garbage onto the public. And now we're getting to a point now where it's still moving higher. And if interest rates stay higher for longer, these people are going to just be choked out in MMA terms. But this next chart really was wild. And this is on the people side. Look at this, guys. Every time personal interest expense to income hits a certain level, we go into a recession. But this time we went sky high, right on through it as the market's trying to make all-time highs. And this is all Yellen juice right here, okay? And with the Fed fighting interest rates, with raising the rates, people are getting stuck with higher interest charges. At the same time, the government's just going balls out spending, and Muhammad's going to meet the mountain here, I think, pretty soon. And it's not going to be a pretty sight. I mean, because this thing, when credit gets cut off, man, just like in 2008, they just started cutting home equity lines like out completely. You could have had 85, 90% equity in your home, and you had a 10% home equity line that you didn't use. They just got rid of it. And I think we're at that point now too, where this credit's just going to literally dry up, go to nothing. And so this is unprecedented. CTA, unprecedented. VIX, unprecedented. Option flows, unprecedented. Spending, unprecedented. I mean, at some point, as Milton Friedman says, there's no free lunch. It's going to be, the ketchup is going to be squirting out of the ketchup bottle here, but we just don't know where it's going to spray.
Yeah, Bob, too, if you look at the chart below, right, you have what I would say was when we were in somewhat normal territory. You had when interest payments got to a certain level, you had kind of expected results, and then all of a sudden we're skyrocketing. But that coincides with the panic response to what was happening with the economy because COVID and all of the shutdowns and things like that. And what ended up happening was M2 just exploded. M2 is just a measure of supply of dollars in the system worldwide, and it covers everything from savings accounts to brokerage accounts to institutional accounts even. And so we just have now and I think that's why we're seeing a lot of metrics getting so extreme on things, and we haven't yet triggered a recession, right? And so I think we're going to just see more extreme readings until, the Fed ultimately is trying to back that M2 out of the system, but they have to do it in a controlled manner. They can't just say, nope, no more M2, and then you're going to create a crash. There's going to be a starvation of liquidity in the system. So they're trying to slowly walk that thing backwards. They're running out of time because Yellen, obviously, with her debt issuance stampede, and we got recession coming. So, what are you going to do if you're the Fed? I think you just have to continue on and just, be reactionary. But I think we have the data here. They have the data too. Their hands are tied. And so, you have this situation now where you have these extreme readings, and, it's just going to be a tough road ahead right now.
Yeah. And look, Yellen's master politician, right? She's going to force the Fed to have to make a decision they don't want to make right
Correct.
into the election year.
Yep.
So from that side of the house, they don't care. They're going to spend because their ultimate goal is not economic growth. It's maintenance of power. Okay. The Fed, their ultimate goal is survival as an entity,
Right.
So that so they don't care about you either,
No.
So we're in a situation here where everyone's self-interests are going to be granted, and they have more power than we do. We're just going to have to, go with the flow. But I think we're going to get the worst of both worlds. We're going to get a recession, and we're going to get a high cost of living.
Right.
And nominally, it's going to look like we're not in a recession. See, I always kind of disagree with you. I think we're in a recession now. It's just that you can't manifest it when the numbers are papered over.
Right,
Venezuela is never in a recession either.
Right.
But they're basically becoming Zimbabwe, and I think that's what's going to happen here. Not that we're going to have a Zimbabwe event, but it's just going to become increasingly apparent to people that your standard of living is being destroyed. Look, I just got my homeowners association's raising our rates 10% next year. I just got my health care renewal. It's going up 11% this year. So I don't know where the hell the 2% inflation's coming from. It's stuff that I don't buy. And I think that's the stuff where people are really getting frustrated. I don't think they have it weighted right for people. And I think it's just going to literally just come to a halt, just like it did in 2000 and 2008. Literally, it's an elevator ride down.
Well, because it's 2% inflation on already 20% inflation, right? So it's not 2% inflation. It's just, now we're at 22% inflation because you have to look at everything from, 2020 till now. And the long-term inflation chart is just ludicrous. No one's ever going to look at that. The Fed never brings up the 3-year inflation rate. The administration never brings up the 3-year inflation rate. But that's why it's a joke, because you're like, oh, the rate of expansion is down to 2% or getting back down to 2%. Guys, you guys need to give us a little bit of deflation here. That is like mentioning cancer to somebody, right? Because deflation, they're so worried about the deflationary spiral and the deleveraging that can come along with that. And the other thing too, going back to this interest payments from companies that can't pay their bills on interest rates. If you look, like, why are we so elevated? Like in 2008, you were at a low reading, which is normal. Okay. You figure, we're in 08, the market was up, so we should have companies in better shape. And then all of a sudden, then the crash happened and it spiked to 15%. But that's where things changed. That's where they decided that printing money was the way and low interest rates were the way. And all low interest rates really did was allow more and more companies that weren't profitable to stay in business. Because at the end of the day, if you have access to cheap debt, you can continue to cash flow regardless if you're profitable or not. Some guys live off of the philosophy that cash flow is king. Forget about it. You can be unprofitable till kingdom come as long as you're cash flowing. The problem with that is over time, you're going to introduce inflation, and that's what's happened. And COVID was just a cherry on the pie when they just decided to just smash the print button. You can't, it was okay. We were kind of managing that excess in the system until that happened and it broke the back. So now you're in a situation where they're either going to have to put their foot down and fight the administration and fight the Treasury hard, which they probably won't do, because at the end of the day, they need to keep the bond market propped up. And I think that's where the rubber meets the road in this whole scenario. The bond market cannot fail. If our bond market fails, the entire world economic system is going to implode. And I don't want to hear about BRICS or any of this other stuff, because they're not in a position to backstop any of this. Only the American economic system is able to backstop all this stuff. And the whole entire economic system of the globe is really built around that. So when it comes to the bond market, our bond market is in trouble. They're going to go back to printing. And this is where the poker game comes to a head, because everything that we have been saying, why you should have Bitcoin, why you should have gold, other hard assets, that's going to be where that insurance policy comes in and it pays extremely well. And I think that's the inevitable outcome. It's just a matter of when, not if.
I agree. So guys, give me your thoughts on this. What are you guys seeing? In the meantime, hit like, subscribe, notification, ring that bell. Come join us with our service and enjoy the rest of your weekend. We'll catch you guys on Monday.
Trade Genius.